Kai, rookie investor. Maya, senior investor. Nadia, financial journalist. Marcus, retired banker. He spent 3 months researching AI stocks in early 2024, Kai asks. He read 17 analyst reports, he watched 11 YouTube videos. Every source agreed this was the opportunity of the decade. He bought in, he was thorough, he was confident, and he was approximately 4 months too late. The opportunity of the decade had already happened. In the decade. Earlier, did you know the investment everyone is buying is already too late? Someone knew before the crowd. He did not feel like he was following a crowd, Kai admits. He felt like he had done his research. He had read 17 articles. He had watched the earnings calls. He had compared the valuations. The problem was that all 17 articles were written after the price had already moved. He was not doing research. He was documenting what had already happened and mistaking it for a prediction of what would happen next. That distinction turned out to matter quite a lot. The recommendation cycle repeats across every decade, Maya states. The investment gets talked about after the early gains are made. The media picks it up after it has become a story. The retail investor hears about it after the story is months old. By the time the recommendation reaches the inbox, the best of the return has already been captured by those who were there before the crowd. Series 3 is built around one observation, Maya recalls. Financial behavior matters more than financial knowledge. Epi 12 through Epi 15 explained why reactions, bonuses, raises, and timing all cost money. This episode explains the last of the 6 biases, why the investment everyone is recommending is the most expensive one to buy, and who profits from the moment of purchase. The algorithm needs the subscribe signal, Kai mentions. If this episode is worth the time, the button is below. If it is not, the button is still below. DALBAR has measured investor behavior annually since 1994, Nadia states. In their 2025 QAIB report covering calendar year 2024, they catalog the behaviors driving the 888 basis point performance gap. Herding is one of the documented mechanisms defined as copying the behavior of others, even in the face of unfavorable outcomes. In 2024, DALBAR found that investors withdrew from equity funds in every quarter, with the largest outflows arriving just before a major market rally. They arrived late, they left early. DALBAR's guess-right ratio fell to 25% in 2024, Nadia reads. Investors timed their decisions correctly 1 in 4 times. 3 in 4 moves, buying or selling, made the outcome worse. The recommendations were confident. The timing was always wrong. The PMC published a systematic review in 2025 analyzing 63 empirical studies on behavioral biases. Their finding on herding, it can lead to investment bubbles and significant financial losses. The herding mechanism is not neutral, it amplifies the upswing and accelerates the crash. The crowd arrives late, the crowd leaves late. The crowd generates the very conditions that cost the crowd. The recommendation cycle has repeated across 3 decades, Maya confirms. The article runs at the point of maximum excitement. It captures the most clicks, the most views, the highest advertising yield. It is not calibrated to investment merit. It is calibrated to audience attention. The retail investor hears about it after the story is months old. By that point, the anticipated return has already been captured. He did not feel like he was following a crowd, Kai figures. He had done his research. But all 17 articles were written after the price had already moved. He was not doing research. He was documenting what had already happened and mistaking it for a prediction of what would happen next. He was the crowd. He just had a spreadsheet. In 2024, AI infrastructure stocks became the most covered sector in financial media, Maya confirms. Supermicrocomputer, SMCI, rose approximately 900% from its early 2023 lows to its peak in March 2024. Financial coverage reached peak volume around the same period. Retail investor inflows followed the coverage. By the end of 2024, following the disclosure of accounting concerns and external investigations, the stock had fallen more than 75% from that peak. Smith et al. Found in 2025 that herd investors do not trade on market fundamentals, they trade on sentiment movements. The article arrived. The excitement peaked. The retail investor bought. The institutional investor who entered earlier was positioned to exit into that buying pressure. 25, Nadia states. DALBAR's guess-right ratio for 2024. 25% of investor timing decisions were correct. 75% were wrong. The recommendation arrived. The investor acted. 3 times in 4. Worse outcome. Back into it. 2 investors, same asset, same year, Nadia states. Investor A buys before the mainstream recommendation, based on fundamental data before the media cycle peaks. Investor B buys at maximum recommendation, when coverage is highest and the price has already reflected the excitement. The investor who arrived before the recommendation captured the ascent. The investor who arrived at the recommendation captured the peak and what followed it. The gap is not analytical skill. It is the timing of the information acted on. Herding investors arrive when the return is already made, Nadia states. The investment reaches mainstream recommendation at the exact moment it is most expensive, when the anticipated return has already been captured by those who were there before the story was written. The crowd is not late because it is uninformed. It is late because the information it acts on was produced after the event it describes. The investment everyone is buying has already priced in the return. That is the complete answer to the thumbnail question, Nadia confirms. And the financial media, which generates its highest advertising revenue when investor excitement peaks, surfaces the recommendation precisely at the moment the remaining upside is smallest. Popularity signals quality. That is the wrong belief, Nadia states. If many experienced investors are buying something, it must be a sound decision. Social proof is rational in many contexts. In financial markets, peer-reviewed research across 63 studies confirms the opposite. Popularity signals maximum price, not maximum value. Smith, Kilders, Kutha, and Weidmar published in Sage Open in 2025. Time series analysis of herd investor behavior using social media data. Their finding, meme stock traders and herd investors do not trade on market fundamentals. They trade on sentiment movements. The data shows that following the crowd does not reflect sound analysis. It reflects the information available to the crowd, which has always lagged. Source: DALBAR, Quantitative Analysis of Investor Behavior. 2025. Herding documented as a primary driver of the 888 basis point gap. Guess right ratio, 25%. When a stock reaches maximum retail attention, institutional investors, pension funds, endowments, large asset managers are often in the final stages of reducing their positions, Marcus states, quietly. Science Direct published research in 2025 showing that institutional and foreign investors strategically adjust their positions in direct response to retail sentiment dynamics, often counteracting them. The retail crowd buys in. The institutional money exits into that buying pressure. The system that delivers the recommendation, financial media, social platforms, influencer networks, was designed to generate maximum engagement at maximum emotional peak, Marcus confirms. They know that excitement and fear produce the highest traffic. Financial media advertising revenue peaks when investor excitement peaks. The coverage is not calibrated to investment merit. It is calibrated to audience attention. The article that runs at maximum excitement captures the most clicks and the highest advertising yield. The recommendation arrives when the risk is highest, by design. Source: Smith, Kilders, Kutha, and Weidmar, Sage Open. 2205. Herd investors trade on sentiment movements, not market fundamentals. FOMO drives volume. He bought what was popular and wondered why he was the only one who had not made the money yet, Kai admits. The recommendation was accurate. The timing was the problem. He thought he was informed. He was informed about something that had already happened. Maya steps in. Scission. The fix is 2 actions. First, turn off financial media notifications, not permanently, but during the window between the monthly contribution date and the next one. The recommendation cannot influence a decision already automated. Second, when the pull of a strong recommendation is felt, the certainty that this is the moment, use it as a signal to do nothing. The strength of a recommendation is inversely correlated with the remaining upside. The specific action today, confirm the automated contribution is set for an amount sustainable in a market downturn. In the UK, ISA or workplace pension, direct debit set, running regardless of news. In Canada, RRSP or TFSA, standing order before the first of every month. In Australia, superannuation, confirmed salary sacrifice rate is active. In New Zealand, KiwiSaver confirmed contribution rate is set. The automated investor never responds to a recommendation. The fund buys on the same date regardless of what the media says that week. The 1% detail, Nadia states, 30 years of DALBAR data and a 2025 time series analysis across meme stocks and social media, both measuring the same mechanism, both arriving at the same finding. The crowd arrives late. The crowd follows sentiment, not evidence. And the system that delivers the recommendation profits from the arrival. The strength of the recommendation is the signal to wait. He spent 3 months reading recommendations, Kai admits. He was confident, he was informed, he was thorough. He bought at the peak, the one-word summary of his entire research process, late. If this changed how you think about the next recommendation, subscribe. The next episode covers what daily portfolio checking costs in exact numbers. Subscribe so it finds you before the next market story does. Subscribe so you never miss the next one. Next episode, did you know checking your portfolio daily cost you money last year? Most investors find out too late. Episode 17 is coming. Subscribe and you will be notified the moment it drops. The episode that surprised the most people on the Money Unlocked channel is linked bottom left.